You know what's interesting? While everyone's scrambling to stuff more cash into their savings accounts, watching those numbers tick up on their bank statements, feeling secure, there's a quiet shift happening that most people are completely missing. Central banks around the world just bought more gold in a single year than at any point in the last 5 decades. Not stocks, not bonds, not even their own currencies. Gold. Physical, tangible gold bars sitting in vaults. Now, why would the people who literally print money be trading that money for gold at record levels? Let me paint you a picture of what's really happening right now, because this isn't just some abstract financial theory. This is about your purchasing power, your retirement security, and whether the emergency fund you've been building is actually going to protect you when you need it most. Think about what an emergency fund is supposed to do. It's your safety net, right? The money that's there when everything else falls apart, when you lose your job, when the economy tanks, when unexpected disasters strike. It's supposed to be the one thing you can count on. But here's the uncomfortable truth that nobody wants to talk about. That emergency fund sitting in your bank account, it's not actually safe. It's losing value every single day, and the rate at which it's losing value is accelerating. Let me show you what I mean with some real numbers. Gold just surged past $4,000 per ounce. That's a 49% increase in a single year. Meanwhile, your savings account is paying you what? Maybe 4% if you're lucky. And that's before we even talk about what inflation is really doing to your purchasing power. But this isn't just about returns. This is about something much more fundamental. It's about what happens when the system itself becomes the risk. You see, when you put money in a bank, you're not actually storing wealth. You're lending money to a financial institution that's part of a system built on debt, leverage, and the assumption that everything will keep working the way it always has. Your bank account is a promise, a digital entry in a database, a claim on dollars that may or may not hold their value. Gold is different. Gold is the asset itself. When you own physical gold, you're not holding someone else's promise. You're holding 5,000 years of monetary history in your hands. And right now, the smartest money in the world is making a very clear statement about which one they trust more. Central banks added over 1,000 tons of gold to their reserves recently. 1,000 tons. That's not a hedge. That's not diversification. That's a fundamental repositioning away from dollar-based assets and toward hard assets that can't be printed, can't be inflated away, and can't be devalued by political decisions. China's been doing this quietly for years. Russia accelerated their gold purchases dramatically. India, Turkey, Poland, countries that have historically understood the value of gold are loading up like they know something's coming. And here's what makes this even more significant. They're doing this while interest rates are still elevated. Traditionally, higher interest rates are supposed to make gold less attractive because gold doesn't pay interest. But gold hit $3,500 per ounce despite the Federal Reserve maintaining rates at 4.25 to 4.5%. That tells you something profound about confidence, or rather, the lack of it. When gold rises in a high interest rate environment, it means people are more worried about the system itself than they are about missing out on yield. They're saying, I don't care if this doesn't pay interest. I care about whether my wealth will exist at all in 5 years. Now let's talk about what emergency funds are really supposed to protect you from. Most people think about job loss, medical bills, car repairs. Those are real concerns. But there's a bigger risk that almost nobody is preparing for: currency devaluation. Look at what happened in the 1970s. The dollar lost more than half its purchasing power in a single decade. People who thought they had secure emergency funds watched their savings evaporate in real terms. Not because the number in their account changed, but because what that number could buy collapsed. The people who protected themselves, they owned gold. Gold went from $35 an ounce in 1971 to over $800 by 1980. That wasn't just a good investment. That was the difference between maintaining your standard of living and watching your life savings become worthless. We're seeing echoes of that same pattern right now. The money supply has exploded. Government debt is at levels that would have been unthinkable a generation ago. The Federal Reserve's balance sheet is still massively inflated from years of quantitative easing, and now we're watching the consequences play out in real time. Your grocery bill knows this, your rent knows this, your insurance premiums know this. The official inflation numbers might say things are under control, but your actual cost of living tells a very different story. And here's the thing about inflation. It's not just an economic phenomenon. It's a transfer of wealth. When currency loses value, that value doesn't just disappear. It moves from people holding cash to people holding real assets, from savers to debtors, from the middle class to those who own hard assets that maintain their value. Gold doesn't just protect against inflation, it profits from it, because gold isn't measured in dollars. Dollars are measured in gold. When the dollar weakens, it takes more dollars to buy the same amount of gold. That's not gold going up, that's the dollar going down. And right now, there are very specific reasons why the dollar is under pressure that go way beyond normal economic cycles. The BRICS nations are actively working to reduce their dependence on the dollar for international trade. They're settling transactions in their own currencies. They're building alternative payment systems. They're accumulating gold as a neutral reserve asset that doesn't give any single country leverage over their economies. This isn't conspiracy theory. This is openly stated policy. These countries represent nearly half the world's population and a growing share of global GDP. When they move away from the dollar, that reduces demand for dollars globally. And when demand for something decreases while supply increases, the value falls. Basic economics. But there's another factor that most people aren't paying attention to: the paper gold market versus physical gold. See, most gold trading happens on exchanges like COMEX, where people trade contracts representing gold, not actual physical metal. The ratio of paper gold to physical gold is estimated to be somewhere around 100 to 1. That means for every ounce of actual gold that exists, there are 100 claims on that gold in the form of paper contracts. This works fine as long as everyone's content to trade paper. But what happens when people start demanding physical delivery? What happens when the gap between paper prices and physical prices starts to widen? We're already seeing signs of this. Physical gold premiums have been elevated. Delivery delays have been increasing. Central banks aren't buying paper gold. They're taking physical delivery and storing it in their own vaults. There's a reason for that. Physical gold can't be printed. It can't be created with a keystroke. It can't be inflated away. When you hold physical gold, you hold something that has maintained its value across every currency collapse, every financial crisis, every empire that's ever risen and fallen. Think about what that means for your emergency fund strategy. If the purpose of an emergency fund is to protect you when everything else fails, shouldn't it be in an asset that has proven it can survive when everything else fails? Now, I know what some people are thinking. But I can't pay my bills with gold. I need cash for emergencies. That's a fair point. And I'm not suggesting you convert every dollar you have into gold. Liquidity matters. You need some cash available for immediate expenses. But here's what I am suggesting. The traditional advice of keeping 6 months of expenses in a savings account might not be the complete picture anymore. Maybe the real emergency fund strategy is a hybrid approach. Keep enough cash for immediate needs, but store your deeper reserves, your real wealth protection, in assets that can't be devalued by monetary policy. Because the biggest emergency you might face isn't losing your job. It's watching the currency itself lose its value while you're holding it. Let me give you a specific example of how this plays out in real life. Imagine someone who had $100,000 in savings in the year 2000. They kept it in a bank account, earning modest interest. Today, that $100,000, even with interest, buys roughly what $60,000 bought back then. They didn't spend it. They didn't lose it. The purchasing power just evaporated. Now imagine someone who took that same $100,000 and put even a portion of it into gold. Gold was around $270 an ounce in 2000. Today, it's over $4,000. That's not just keeping up with inflation. That's multiplying purchasing power by 15 times. But here's what's really important. It's not about the dollar amount. It's about what that money can do for you. It's about whether your emergency fund can actually handle an emergency. And speaking of protecting wealth in retirement accounts, if you're sitting on $100,000 or more in traditional retirement savings, there's something you should know about. I put together a free guide on how gold IRAs work. It's in the description below. It covers how you can get physical gold into your retirement account without triggering tax penalties. Worth checking out if that's relevant to your situation. But let's get back to why this matters right now specifically. The financial system is more interconnected and more fragile than it's ever been. We saw this in 2008 when the entire global banking system nearly collapsed. We saw it again in 2020 when the Federal Reserve had to inject trillions of dollars to keep markets functioning. We're seeing it now with regional bank failures and concerns about commercial real estate exposure. Each time there's a crisis, the solution is the same: print more money, expand the balance sheet, lower interest rates, bail out the system. And each time they do this, the currency becomes worth less. Not worthless yet, but worth less. Gold is the asset that benefits from this dynamic. When confidence in the system decreases, gold's value increases. When currency creation accelerates, gold's purchasing power expands. When people start questioning whether their bank deposits are truly safe, gold becomes the alternative. And we're at a point now where multiple risk factors are converging simultaneously. Geopolitical tensions are at levels we haven't seen in decades. The global economy is fragmenting into competing blocks. Supply chains that were taken for granted are proving vulnerable. Energy markets are volatile. Food security is becoming a concern in regions that never worried about it before. In this environment, what's the real emergency fund? Is it digits in a bank account that could be frozen, could be bailed in, could lose value overnight? Or is it a tangible asset that's been recognized as valuable across every civilization, every culture, every time period in human history? Here's something else to consider: accessibility. People worry that gold isn't liquid enough. But think about what liquidity really means. It means you can convert an asset to cash quickly. But what if cash itself is the problem? What if the emergency is that cash is losing value faster than you can spend it? In that scenario, gold isn't illiquid. Gold is the liquid asset. It's the thing that holds value while everything else is melting down. You can always convert gold to whatever currency you need, but you can't always convert currency to purchasing power. And the market is telling us something right now. When gold hits record highs despite high interest rates, despite a strong dollar index, despite mainstream financial advice saying it shouldn't be going up, that's the market screaming that something is wrong with the traditional safe havens. Bonds used to be the safe asset, but bondholders got destroyed when interest rates rose. Stocks used to be the long-term wealth builder, but stock valuations are at historic extremes and vulnerable to any economic slowdown. Real estate used to be the tangible asset everyone wanted, but real estate is illiquid, expensive to maintain, and vulnerable to property taxes and local economic conditions. Gold is none of those things. Gold is portable. Gold is divisible. Gold has no counterparty risk. Gold can't be hacked. Gold can't be inflated. Gold can't be printed. Gold simply is, and institutions are recognizing this. Not just central banks. Pension funds are increasing their gold allocations. Sovereign wealth funds are buying physical gold. Even traditional investment firms that spent decades dismissing gold are now recommending it as a core portfolio holding. Why? Because they're looking at the same data you have access to. They're seeing the same debt levels, the same monetary expansion, the same geopolitical risks, and they're making the rational decision to protect their assets with something that has proven it can survive when everything else fails. Now let's talk about the mechanics of what's happening in the gold market right now, because this is where it gets really interesting. Gold mining production has been relatively flat for years. It's not easy to find new gold deposits. It's expensive to extract gold from the ground. And many of the world's largest gold mines are in politically unstable regions or facing environmental restrictions. Meanwhile, demand is surging. Central bank buying is at record levels. Individual investors are accumulating. Industrial demand for gold in electronics and technology continues to grow. And now we're seeing a new wave of demand from people who are starting to understand what's happening to their currency. When demand increases and supply is constrained, prices rise. That's basic economics. But with gold, there's an additional factor: the paper market. As I mentioned earlier, most gold trading happens in paper contracts. These contracts can be created essentially out of thin air. They don't require actual physical gold to exist. This has allowed the gold price to be suppressed below where it would naturally trade based on physical supply and demand. But that system only works as long as people are content to hold paper claims instead of demanding physical delivery. And increasingly, they're not. Central banks want physical gold in their vaults. Wealthy individuals want physical gold in their possession. Even retail investors are buying physical coins in bars instead of ETFs. When this shift accelerates, when the demand for physical gold overwhelms the paper market's ability to deliver, that's when you see price dislocations. That's when the real price of gold reveals itself. And we're starting to see cracks in the system: delivery delays, premium increases, shortages of certain products. These are early warning signs that the physical market is tightening. Think about what this means for your emergency fund strategy. If you wait until everyone else figures this out, you'll be trying to buy gold at much higher prices, possibly with delivery delays, possibly with premiums that make it prohibitively expensive. The time to build an emergency fund in gold is before the emergency, not during it. Let me give you another historical parallel. In 1933, the U.S. government made private gold ownership illegal. They forced citizens to turn in their gold at a fixed price. Then, after collecting the gold, they revalued it higher, effectively confiscating wealth from the population. Could something like that happen again? I don't know, but I do know that governments throughout history have always targeted wealth when they're desperate. They freeze bank accounts, they impose capital controls, they devalue currencies, they confiscate assets. Gold is the one asset that's portable enough to protect, valuable enough to matter, and historically proven to survive government overreach. It's not about paranoia. It's about understanding history and human nature. And right now, we're in a period where governments are more desperate than they've been in generations. Debt levels are unsustainable. Entitlement programs are underfunded. Infrastructure is crumbling. And the only solution anyone seems to have is to print more money and hope it works out. That's not a plan. That's a prayer. And your emergency fund shouldn't be based on prayers. Here's what a modern emergency fund strategy might look like. Keep 3 to 6 months of expenses in cash for immediate liquidity. That's your first line of defense against job loss or unexpected expenses. But beyond that, consider allocating a significant portion to physical gold. Not paper gold, not gold stocks. Physical gold that you can hold, that you control, that can't be frozen or confiscated or devalued by someone else's decisions. This isn't about getting rich. This isn't about speculation. This is about preservation. This is about making sure that when you need your emergency fund, it's actually there, and it actually works. Because the ultimate emergency isn't a broken car or a medical bill. The ultimate emergency is a broken monetary system. And we're watching that emergency unfold in slow motion right now. Every time the Federal Reserve pivots on interest rates, they're admitting they can't normalize policy without breaking something. Every time the government raises the debt ceiling, they're admitting they can't control spending. Every time inflation numbers come in hot despite their best efforts to cool the economy, they're admitting they've lost control of the currency. Gold knows this. The market knows this. Central banks know this. The question is, do you know this? And more importantly, are you positioned to protect yourself when the full implications become clear to everyone else? Look at what's happening in real time. Gold just broke through $4,000. That's not a random number. That's a psychological barrier that, once broken, opens the door to much higher prices. Technical analysts are now talking about targets of 5,000, 6,000, even higher. But this isn't just about technical analysis. This is about fundamental shifts in how the world views money, value, and security. The dollar's role as the global reserve currency is being challenged for the first time since World War II. The petrodollar system that's underpinned American economic dominance for 50 years is eroding. The financial architecture that's been in place for generations is being rebuilt, and gold is at the center of that reconstruction. Countries are asking themselves, why should we hold our reserves in dollars that can be frozen, sanctioned, or inflated away? Why not hold gold instead? Gold that's neutral, that's universally accepted, that can't be weaponized by any single country. This isn't a fringe position anymore. This is mainstream thinking among central bankers and finance ministers around the world. And when the people who control trillions of dollars in assets are moving toward gold, that's a signal you ignore at your own peril. Your emergency fund is supposed to be your last line of defense. It's supposed to be the thing that's there when everything else fails. But if it's denominated in a currency that's losing value, if it's held in a system that's increasingly fragile, if it's vulnerable to decisions made by people who don't have your best interests at heart, is it really an emergency fund at all? Or is it just another risk in a portfolio full of risks? Gold eliminates that risk. Gold is the asset that's there when the system isn't. Gold is the emergency fund that works when traditional emergency funds fail. And right now, with gold at record highs, with central banks buying at record levels, with geopolitical tensions rising, with monetary policy in uncharted territory, right now is when you need to be thinking seriously about what your emergency fund really consists of. Because the next crisis won't announce itself. It won't give you time to prepare. It'll happen fast, and by the time everyone realizes what's happening, it'll be too late to position yourself properly. The people who protect themselves are the ones who act before the crisis, not during it. They're the ones who understand that the ultimate emergency fund isn't in a bank. It's in your hands, in the form of an asset that's survived every crisis, every collapse, every empire that's ever existed. That's gold. That's the real emergency fund. And that's what the smartest money in the world is buying right now, while everyone else is still trying to figure out what's happening.